Hello, everyone. If you're looking at markets right now and thinking this is easy mode, pause for a moment. The next move could define what your portfolio looks like for the next 5 years. Here's Tox, the uncomfortable question nobody wants to answer. What yes your maximum upside from here? And what a yes your maximum downside? Because if the upside is a polite 10-15%, while the downside could be 30, 40, or even 50%, that's not opportunity. That's asymmetry in the wrong direction. Today, we're connecting the dots that most people keep separate. The economy, the labor market, the stock market's passive flows, the housing slowdown, the AI spending narrative, bond yields that refuse to behave, and why precious metals and energy inputs are flashing signals Wall Street would rather you ignore. The debate for 2026 is heating up. One camp warns of slowdown. Weak consumers, a frozen hiring market, sluggish housing, rising delinquencies, inflation pressure, stubbornly high bond yields, and geopolitical uncertainty. The other camp forecasts a boom. AI capital spending, energy infrastructure buildouts, reshoring of manufacturing, potential capital inflows, deregulation, and business-friendly policies that could kickstart a golden age. Which is it? Here's the trick. The economy is always doing both. Think of a bucket with water pouring in at the top and draining out at the bottom. Both are happening. What matters is the net level, approximated best by output and jobs, GDP, and the labor market. The problem is those two are telling different stories. Broad output numbers can look resilient, but the labor market may already be showing cracks rarely seen outside of recession-like conditions. And here's a crucial distinction. The economy is not the stock market. A slowing economy can coexist with a rising market, and a growing economy can coincide with falling stocks. Why? Bad economic news can trigger rate cuts, which trigger buying reflexes. Weak jobs lead to expected cuts, yields drop, and indexes spike. If you're trying to predict stocks, watch liquidity and flows. If you're trying to understand the economy, watch jobs and incomes. And if you're trying to protect wealth, watch where the two collide. The single biggest force creating market disconnection from fundamentals is the passive machine. Monthly retirement contributions, index allocations, and automatic plans pour into the market regardless of price. The largest companies get the largest flows, not because someone decided valuation was fair, but because the rules say buy. That's why fighting a rising market can be dangerous, even when macro conditions look absurd. Here's the cliffhanger nobody wants to face. What happens when the passive machine stops buying? It could be unemployment rising, a credit event, a sudden drawdown, or something completely unexpected. Eventually, the machine's direction changes, and when it does, the market can drop faster than you can process. To understand whether 2026 will be boom or slow, start with the labor market. It's the cleanest signal. Weak job growth softens consumer demand, spreads to discretionary spending, then shows in delinquencies, corporate revenue, and eventually layoffs. It is a slow-moving chain that most people ignore. But if the labor market is weaker than headlines suggest, the economy could already be softer than the consensus expects. Now, consider the AI productivity argument. Could output grow while job growth is flat? Over decades, yes, but over quarters, productivity gains rarely offset immediate demand loss from disappearing jobs. Demand is GDP's oxygen. Without it, growth falters. Then there's the K-shaped economy. The top slice of households drives spending, supported by asset prices, while the bottom slice struggles. Retail sales can appear fine, while a large portion of the population is squeezed. That creates hidden vulnerabilities. If markets stumble, the wealth effect hits the top slice, slowing spending. Housing is the slow-moving iceberg. It doesn't pivot like a meme stock. Rates rise, affordability drops, demand softens, inventory shifts, and price adjustments creep in. Housing is more than shelter. It's collateral, confidence, and consumer behavior rolled into one. Put it together. Soft jobs, soft housing, rising delinquencies. What offsets that? AI spending, infrastructure, and capital inflows, but their durability is uncertain. Incremental revenue may not match incremental spending, and boards may slow capex. Markets don't just price current profits, they price expectations. And when expectations are extreme, you don't need disaster for a drop. Just less good than expected. This is where asymmetry becomes critical. Max upside on the broad index, maybe 10-15% if everything goes perfectly. Max downside? Could be 30, 40, 50%, or worse. That is unfavorable asymmetry. Does that mean you short? Not necessarily. Shorting broad indexes is perilous because passive flows can keep pushing prices higher far longer than nerves can endure. The real game is positioning, risk management, and understanding exposure. The bond market quietly tells another story. Growth slowdowns and expected rate cuts lower short-term yields faster than long-term yields. Curve steepening can happen in both boom and slowdown scenarios. Big shifts are where portfolios break if unprepared. What would it take for the boom narrative to succeed? sustained private investment, hiring that follows spending, strong consumer demand, manageable bond yields, and stable or accelerating housing. That's a lot of moving parts. Temporary bursts are possible, but stimulative policy can simultaneously ignite inflation pressures, keeping yields high in tightening conditions. Meanwhile, money moves toward momentum. Metals, commodity-linked sectors, and sector rotations can perform quietly beneath a flat headline index. Leadership shifts before headlines change, and catching those shifts early is crucial. Now, precious metals. Gold and silver aren't just inflation hedges. They respond to trust, counterparty risk, and uncertainty. Geopolitical stress, sanctions, and currency friction often coincide with stronger metal demand. Trends and drivers matter more than narrative hype. Metals can spike and dip around headlines, with catch-up dynamics between sectors and assets. Silver, for example, often lags gold, then catches up violently. Large caps can lead, small caps lag, then small caps catch up. Understanding catch-up helps avoid buying the top of a leader and missing the breakout of the laggard. The core question, will the economy slow or grow in 2026? Likely both. Some industries may see strong capex, while consumers pull back in others. Job growth may continue in pockets, while layoffs rise elsewhere. Headline numbers may look strong even as the underlying pulse weakens. The market may rise due to liquidity, but asymmetric risk remains. Long-term investors don IAT need to predict every twist. They need to avoid catastrophic errors from overexposure to crowded trades at extreme valuations. High valuation isn't a timing tool. It's a warning of potential catastrophic outcomes. AI leadership is a potential accelerator of a risk. AI is real, but monetization speed may be overestimated. Profitability shocks can compress multiples, affecting index-weighted stocks, spending, the labor market, and ultimately passive flows, a chain reaction that turns narrative into cycle. Finally, markets aren't one thing. Indexes can be flat while sectors move violently. Rotation rewrites the playbook quietly. Focus on expanding strength, breadth improvements, lagging sectors breaking out, and commodities or international markets entering trend. Position size matters. Sleep is risk management. Emotional decisions during volatility punish the unprepared. Hard assets are a theme, not because they're magical, but because they diversify away from promises. Metals, commodity-linked equities, land, and productive capacity. Nuclear fuel is another emerging area. Energy demand rises, grids are stressed, multi-year bases break out, but position carefully. In a world of unfavorable asymmetry, caution is rational. Even if the market closes higher, brutal intra-year drawdowns can destroy over-leveraged positions. Volatility matters more than annual returns. Markets move in lines you don't control. Jobs, housing flows, capex, metals, and passive machines, they all intersect. Understanding these intersections is how you survive, thrive, and see the next phase before it hits headlines. First, the labor market isn't just one headline number. Payroll counts matter, yes, but so do hours worked, participation, wage growth, and the quality of the jobs being added. Many hear jobs up and assume the economy is fine. But if hours worked are drifting lower, full-time jobs are flat, and part-time roles jump, the story is different. If wage growth slows while prices stay sticky, consumers don't collapse instantly, they quietly downshift. They trade down, delay purchases, lean on credit. That's exactly how delinquencies creep in long before anyone starts talking recession. Add another layer, many businesses aren't firing aggressively. They freeze hiring, cut hours, or let attrition do the layoffs for them. That's why the labor market can look stable on paper but feel weak in real life. Ever wonder why friends complain there are no jobs, while the data says growth? That disconnect hides right here. Here's a cliffhanger. When the job market breaks, it usually happens faster than expected. Months of soft stability can turn into sudden, visible layoffs in a single quarter. So don't just watch one number. Watch trends, revisions, and breadth. Next, the consumer isn't one consumer. There's the top consumer and the bottom consumer. The top consumer is insulated by assets and higher incomes. The bottom consumer feels rent, groceries, fuel, and debt immediately. When rates rose, the bottom consumer felt it first. The top consumer only felt it if markets dipped. That's why 2025 and early 2026 can feel like two different economies, depending on who you are. This matters for 2026 forecasts. If you assume the bottom consumer recovers, explain how. Wage growth, lower inflation, lower rates, tax relief, or direct payments. If you assume the top consumer spends more, what drives that? Assets are already high, uncertainty is rising, and caution can increase, not decrease. The boom case needs a real pathway, not slogans. Now, the stock market's dependence on the wealth effect is where things get uncomfortable. Normally, the economy leads and markets follow. But today, markets can lead the economy. If markets rise, confidence rises. If confidence rises, spending rises. If spending rises, companies hire. The reverse is true too. Falling markets lower confidence, spending, and hiring. That's why valuations matter. Not as timing tools, but because when a collapse happens, the economic feedback loop is brutal. Here's the scary part. Expensive doesn't mean it must fall soon, it means fragile. Less room to absorb disappointment, priced for smooth sailing in a world that isn't smooth. The question isn't when it falls, it's what happens if it falls. That's where planning begins. Passive flows create hidden traps. They don't care about valuation, earnings, or geopolitical risk. They follow a schedule. Retirement, auto buying, and index contributions can inflate bubbles. If top names dominate the index, the market becomes hostage to a few stocks. If those stocks stall or break, the index breaks. Then the wealth effect hits the top consumer, and the economy feels it. Leadership matters. For 2026, leadership has concentrated in big tech and AI adjacent names. More spending, more chips, more data centers. Simple stories until cracks appear. Watch 3 key cracks. 1, monetization. Millions of users don't equal profits. Costs, computing, energy, hardware, compress margins. Pricing power weakens, margins compress, valuations compress. 2, capex fatigue. Firms invest, returns lag, spending slows, supply chains feel it. 3, circular risk. An ecosystem funding, buying, and valuing itself looks strong until the cash flow test arrives. Cash doesn't care about dreams. It demands reality. Timing matters. Markets often price timing wrong. Here's the cliffhanger. Leadership rotation happens quietly. Most investors notice too late. Old winners dominate portfolios while new trends emerge unnoticed. Watch breadth. Fewer names carrying the index is unhealthy. Broad participation can extend a rally. Collapsing participation is a warning. Bonds are the quiet judge. Equities are emotional. Bonds are cold. Yields tell you how expensive money is and how tight conditions are. Long-term yields high. Housing, investment, and credit feel it. Short-term yields falling. Liquidity improves, but it can signal stress. When bonds and stocks disagree, volatility rises. Think of 2026 as 3 regimes. 1, soft landing with liquidity support. Growth okay, inflation controlled, rates drift down, stocks grind higher. 2, slowdown with rate cuts, jobs weaken, central bank cuts, market rallies on expected easing, but scary drawdowns appear inside the year. 3, inflation friction. Policy stimulates, inflation stays sticky, yields stay high, stocks and bonds struggle, hard assets often shine. You don't need to guess perfectly, avoid overcommitting. Build a portfolio that survives, optionality, diversification, manageable positions. Defense can be cash, low volatility assets, or uncorrelated exposures. Hedging is not predicting. Hedging is the right to be wrong without being destroyed. Like a seatbelt, you wear it not because you plan to crash, but because crashes happen. International markets and commodities may lead in 2026. Dollar weakness, commodity repricing, energy input changes, or geopolitical uncertainty can create winners and losers. Energy embedded in everything can squeeze margins, but owning producers can offset risks. Combining energy and metals can hedge exposure across sectors. Markets aren't one thing. A flat headline index can hide sector shifts. Smaller companies waking, defensive sectors leading, commodities outperforming while tech chops sideways. Simple weekly habit. 1, broad index versus equal weight. Outperformance signals, breadth improvement. Underperformance signals, fragility. 2, small caps versus large caps. Small caps lead, liquidity improving. Small caps break while index holds, warning shot. 3, commodities versus bonds. Commodities firm, bonds weak. Inflation pressure, bonds rally, commodities soften. Growth slowing, watch labor revisions, housing volumes, the yield curve, leadership, credit stress, and money rotation. The moment most feels safe is when risk is highest. Build your plan while screens are calm, and once panic hits, planning becomes impossible. Pick one indicator you'll follow weekly: jobless claims, credit spreads, housing inventory, or the yield curve.